Yeah, how was London?
Oh, it was good. We had a great trip. It's good to be back, but yeah, we were over there for 4 days and got to see all the sites. It's a big city, 9 million people, but it doesn't have a big city feel because it never grew up. It's got a downtown with a few skyscrapers in it. But most of the city's just so historical. They've left these buildings that have been around for thousands of years. Has a real neighborhoody type feel, which was really fun. Made it interesting to go check out the different neighborhoods, and we took one of the double-decker bus tours. And I ran the marathon, so they shut down the streets along all the major tourist attractions. So I got pictures of me running by how was the Big Ben and the London Eye and Parliament, and then the race finishes right there at the palace. What's the
Buckingham.
Yes, Buckingham Palace. So that was fun. And there's 40,000 people that run that race. So that's just an incredible adrenaline rush to be a part of. The race, they have 3 different starts, depending on which corral you're in.
Like flights are actually starting
At 3 different starting points. So you will run a different race route depending on where you start. And then all of the routes converge around mile 3.
Yeah.
That was, yeah, it was great. We had a blast.
It's 26.2, right?
Mhm.
How do you get into that? Is that, you have to enter into? like,
Yeah,
auctions?
it's open. It's kind of a lottery.
Oh, okay.
I got in based on the time I ran last year in Kansas City and Indy. I ran those 2 races last year, so I was fast enough to qualify for the invite only event, which that's pretty cool too. You get your own starting corral, and they give age group awards to all the folks that are super fast, which was not me. I didn't win any award, but I got invited to the awards party, and that was partially hosted by Eliud Kipchoge. Well, he was the featured guest. He's the guy who broke the world record the week before and then ran a marathon and a world record time of 2:01, which is a 4:32 pace. So
For every mile.
yeah, for every mile. I can't run that.
Someone breathe 2 hours.
So same dude, but the sub 2 hour race doesn't qualify as a world record because it didn't meet the conditions to qualify. It wasn't, first of all, for one, it wasn't a real race. And then he had a pacing crew throughout.
Right, someone was running with them.
Yeah, which not only were they running with him, they were in a flying V formation, which breaks the wind
Sure,
the whole time.
yeah,
And that formation alone will take a minute off your time.
right.
Berlin's a loop course, so there wouldn't have been any wind advantage.
Right.
Now London's a point-to-point course, so on the right day, you could potentially get a wind-aided time. We didn't. We were running into the wind, but didn't matter. Yeah, it was still a blast. 30. So, hey, Zoom crew, I got 2 of you out there. Can you hear me? Oh, how about I admit all? Let's try that. Hey, Christian, can you hear me? Anybody from the Zoom crew? Can you guys hear me?
Yes.
Okay, terrific, terrific. Well, I was just chatting after being out for a week, sharing a little bit about my vacation, but let's switch gears and talk about the exam. Let's talk about homework. Let's talk about our research projects. How's everybody doing? Any questions, complaints?
So where would you say the best place to be in the research project at this point would be?
You're still collating all of your materials. By now, you should have gone out and downloaded the 10K document, and you should be working your way through that. So tonight, we're going to talk about liability and recognition of non-owner financing. So after tonight's lecture, at some point this week, you should go out, look at that 10K filing, look at the fine print for all of the fixed income, bonds, notes payable, other debentures that your company has outstanding. Are there any covenants tied to those? Where do they trade at the market? Where do they trade in the market? Do they trade at a premium? Do they trade at a discount? How historically has your research company reported these? And are there any issues with those types of debt instruments being under or overvalued? Last week and the week before, we've tackled a topic. And ideally, you would just be moving systematically through the topics as we cover them so that you can ask questions and engage. But realistically, I know these projects get put off towards the end of the semester. And that's okay too, because we don't have a final in this class. So that's typical. So if that's where you are, no problem. But you should have done some work to begin gathering information. So at a very minimum, you have now identified your company. You've done a report on the prospectus, and you've been to their investor relations website to familiarize yourself with the company presentations. And they see themselves and the face that they want to show the world. And during our class time, we begin to pick that apart a little bit. Where might they be disingenuous in how they're presenting themselves to the world? Maybe, maybe not. Okay. Well, if you think of a question as we go, let me know, and we can circle back around. Tonight, I'm going to lecture over Module 7, which is non-owner financing. Non-owner financing is debt. When you think about opening up your company, whatever that is, engineering firm, software firm, lemonade stand, to do that, very rarely, there might be an instance, if you can think of an instance offered up, but very rarely do revenues come in before any expenses go out the door. If you're delivering a service or producing a good, usually have raw materials to buy, you got your signage to set up, you got to attract your company. That's a sales and distribution challenge, and all that takes money. Where do you get that money? Well, maybe you're fortunate and you've saved enough money to start your own business. But that would be unusual in nature. Most of the time, and I'm no different, I started my own investing firm in 2007. And what did I do? My mom and dad, hey, how would you like to invest in my new advisory firm? So I get a loan from mom and dad. That's probably one of the most common ways any entrepreneur launches their business. Call it the 3 Fs, friends, family, and fools. Initially, launch your business. And then if you're lucky enough to be successful, they all get paid back. But as you probably know, most businesses fail, which is why we call it friends, family, and fools. They loan you money. That's what we're talking about tonight, those loans. When you get into a more sophisticated financing situation, most of that money doesn't come from friends, family, and fools. It comes from banking situations. And those banking relationships are governed by GAAP accounting. We're going to take a little dive into the GAAP accounting for those financing measures tonight and talk about how we recognize those, where the estimates are, what the accounting looks like, and just familiarize everybody in class with the fine print that's associated with that. And my hope is that most of this will look familiar. We're going to talk about bonds tonight, debt financing, It can come from a bank, but it can also come from public institutions. So when you get to be a multi-billion-dollar corporation, like most of us are looking at here in the publicly traded markets, so S&P 500 type of companies, most of those companies go to the public when they need to borrow. So they will facilitate this transaction through one of the largest investing banking firms in the world, they call it Goldman Sachs. They go to Goldman and they say, we need to borrow $10 billion. Okay, Goldman says, we're not gonna loan you $10 billion, that's more than we have, but we will facilitate this transaction on your behalf. So Goldman works with their lawyers, they draw up all the paperwork, and then they tap into their consortium of broker dealers across the country, and they work with other banks to sell bite-sized pieces of that offering. That total bond offering is 10 billion, but through that network of banks and their customers, we all now have the option to participate in this transaction. And we do that by buying what is called a single bond. Those bonds are $10 billion worth of loans chopped up into $1,000 increments. And that bond comes with what's called comes with a face value. Used to be you'd get a piece of paper, and that piece of paper would have a bunch of tickets hanging off the bottom of it. And those tickets were called coupons. And every month or every quarter, you'd tear off one of those coupons and you'd mail it into, let's just use General Motors in this example, who had borrowed all the money. General Motors borrowed the money from you in the form of a bond. And in exchange for that coupon, General Motors would send you back an interest payment. And this would take place over the life of the bond. And at the end of the term, General Motors would give you your money back, typically that $1,000 face value. None of that happens anymore, but the principle is the same. And it's all done electronically. And we still use the archaic terminology. So you'll hear me refer to face value of the bond, which is principal value, which is the $1,000 we initially loan General Motors in this bond transaction. And you'll hear me refer to coupon value or coupon yield, which is the interest that you earn on one of those coupon payments, typically semi-annually, when you send it into General Motors. So on a $1,000 bond, that pays a 6% yield. When you send that initial coupon in, you're gonna get 6% yield on your money. So if it's a $1,000 bond on an annual basis, you get $60. The bond typically pays every 6 months. So every 6 months, you'd get $30. And that's the very basics of a bond transaction. Where this gets complicated, and I'm going to try to walk through this tonight, and I'm using you all as guinea pigs, because I have a bunch of clients that are holding me accountable to what's going on in the bond market these days. Because the bond market has taken a dive just like the stock market has, and my clients want to know what's up. Well, what's up is interest rates have increased significantly, predominantly driven by the Federal Reserve. And the Federal Reserve does that because they want to slow down the economy. And when you increase interest rates, it makes it more expensive to borrow. And when it's more expensive to borrow, companies borrow less. And when companies borrow less, they have less money to invest in sales, marketing, mergers and acquisitions, new products, new real estate. That trickles over into the personal finance market because housing is now more expensive. And when housing is more expensive, people buy fewer homes, people build fewer homes, and when people buy and build fewer homes, they buy fewer mattresses and air conditioners and dishwashers and everything else that goes into a home. And the whole economy just kind of moderates a little bit. When the whole economy moderates, we get a decrease in demand. And when we get a decrease in demand, the relationship between supply and demand naturally dictates that prices start to decline. That's what the Federal Reserve is trying to do. They're trying to get a handle on the inflation rate, which has been running at 8+ % for the last 3 months. Problematic for bond investors, because if you've just engaged in a transaction with General Motors, and I'm going to decrease that interest rate in our example to make it more relevant. Now General Motors is paying 3%, and you bought this bond at the beginning of the year. Okay. At the beginning of the year, we all had some extra cash laying around. said, oh, I'm gonna take this $1,000 that I have and put it to work. I'm gonna buy a bond from General Motors because I know they're gonna pay me 3%. And every 6 months, I'm gonna cash a coupon. Well, what happens? Interest rates rise significantly. And now we can go out into the market and buy that same bond, and it's gonna pay us 6%. And you're thinking, darn, I wish I would have waited, because if I would have waited 6 months to buy that bond, I could have earned 6% on my money. I could have bought a bond with all these coupons hanging off that would pay me 6% on my money. But I bought one 6 months ago and it only pays me 3% on it. So you say, I know what I'll do. I'll sell this one and I'll buy one of these new ones that pays 6%. Here's the question. Who wants to buy that first bond from you? Who is the buyer?
The company gonna try and buy it back?
Perhaps. I want to sell you my bond that pays 3%. How much are you going to give me?
Less than what you paid for it.
That's what all of my clients are trying to understand. What we bought 6 months ago is now worth less, and the number on the bottom of my statement is smaller. What gives? That relationship, without fail, is one of the most, it's just complicated. I think it runs counterintuitive to anybody that hasn't taken a finance class, an investment class, or a financial statement analysis class. Because we all naturally think, well, when interest rates go up, that's good, right? When interest rates go up, it makes your old bonds, everything you bought in the past, less valuable. Okay, now, you've agreed to pay me less than what I paid for it. How much less?
That'd be based on how many coupons are left on it, the term of it, and then the difference between what the 6% and 3%.
Okay, so you're thinking like an investor. You're naturally asking yourself, well, I can buy this other bond over here that pays me 6. So what's my indifference point? My indifference point is the number that makes the two things look exactly the same. So if we paid 1,000, then we're going to be able to sell it for 900 or 850. I can't do the math in my head. You usually do the math with a financial calculator or an Excel spreadsheet. But when you use that financial calculator, what you're going to find is that discount from 1,000 to 900 or 1,000 to 850, it's exactly the amount that makes the new yield, what we call the effective yield on the old bond, equal to 6%. So now you have an old bond, or you have this old bond. It has coupons that are paying 3%. But you know, at the end of the term, you're going to get 1,000 back from General Motors because that's what's printed on the face value of the bond. That's the principal of the bond. General Motors is not going to default on that. So when they pay you 1,000, the difference between what you paid in the secondary market, when we sell these bonds to each other, that's called the secondary market. That differential makes up for the shortfall in interest, which is another one of the challenges in communicating to my clients, because I want them all to know that while if you were to sell this bond to somebody else today, value of that bond is lower. You hold on to that bond, General Motors is still going to pay you $1,000 at the end of the term. So while the value might be less today, the cash flows you will receive are identical what they were when you bought the bond. So have you really lost any money? Attractiveness of the bond relative to other bonds might have decreased, but that capital loss that shows up at the bottom of your statement is going to be recouped over the life of the bond as you collect those interest payments and ultimately collect the face value. That's what I'm trying to repackage. You know, as I explain that to everybody in this class, I'm also trying to repackage it in a way that lets everybody know that when they open their statement from Fidelity or Schwab or TD and they see the big loss in the last 6 months to 12 months, they can take that with a grain of salt and a deep breath and sleep easy at night, because all of that loss is eventually going to get repaid to them, assuming that the bond market doesn't default. And most of those bonds are backed by the full faith and credit of the United States government. So you can take confidence in the notion that if the United States government defaults on its debt, you have bigger problems than what you've lost in the bond market, because that's an Armageddon type of scenario, at least during our forecast period, which is the next few months to the next few years. Although, notwithstanding, did you see that headline this week about how much the Biden administration, how many anti-radiation drugs they've stockpiled in the last 6 months? It's alarming. Yeah. So what are they preparing for?
So do those bonds, are they required by both the company and the person? Are they out till maturity, or can the company buy them back early?
That's a great question, and we're going to be talking about that tonight. I task everybody in this class every week with thinking like an analyst, First, we gain an understanding of the accounting. Then we gain an understanding of the nuance and the estimates and the assumptions that go into the accounting. Then we try to think like a cynic about how that might be misapplied if you were so inclined. Well, then we think like an analyst and we ask ourselves, what's the opportunity here? Because if you're in the world of venture capital or merger arb, you might be able to identify a company with a lot of bonds on their books that are trading at a deep discount. And some management teams look at that and they say to themselves, it might be very beneficial for us to go out and buy our own bonds in the market, because they're trading at a discount that gives us the opportunity to basically refinance our whole company. Or in another very keen move, and you saw Ford do this, and they looked like an absolute rose of a company. This was Alan Mulally in 2007, KU graduate, by the way. He was their CEO, and I don't know if he was just foresighted or lucky. It doesn't really matter. Interest rates were low, and he went out and he borrowed billions and billions of dollars as kind of a cash reserve. And I'm sure he sold it as the next new growth initiative for Ford Motors globally, because you have to have a prospectus that goes along with all these bond offerings. So it was a big deal. But effectively, it positioned Ford to navigate through the great financial crisis without having to go to the government for a bailout loan like GM did, like Chrysler did. And they just looked brilliant. Mulally looked brilliant, and it changed their whole marketing campaign because they were able to position themselves as the car manufacturer that didn't go for a bailout. And that was very well received by the American public during the time. So sometimes it makes a whole heck of a lot of sense to go borrow when rates are low, when you don't need the money as a rainy day fund. But that's one of the things I'll be asking you to do, is to check the back of your 10K filing for the disclosure table that shows all of the borrowings that your company has outstanding, what their yield is, what their original coupon rate was, what their effective yield is today, meaning where they trade in the market today, and then whether or not they trade at a discount or a premium. Another comment I'll make on that question, do companies buy their own debt back? Another reason why a company might buy their own debt back in the market, say, for example, they're currently paying 5%. Their situation might be much more credit worthy than it was when they issued those bonds. If that's the case, they might be able to refinance that debt. They could effectively buy all that back and then refinance it or issue a new debt at a lower interest rate. And on a personal level, this happens for everybody in the room that may or may not own a home. It's happened to me several times. I've been a homeowner since '99. And interest rates go up and interest rates go down, and periodically you might want to tap into some of that equity for a home equity loan or a line of credit. There's an interest rate associated with that. Well, when interest rates go way down like they did a few years ago, and all of a sudden you can get a mortgage at 3% or less, I think they fell as low as 2%. Well, now you want to borrow 2%. You don't want to pay 6 if you can borrow 2. So you borrow a whole bunch of money at 2, you pay off the old debt, and a lot of times you'll pocket a little bit during that process. That's the same basic transaction for corporate America. Just think with that in mind. If that helps you at all, as a homeowner or a potential homeowner, or even if you have credit card debt outstanding, you can do the same thing. If you have credit card debt outstanding with all sorts of consolidation companies around the globe who will take a look at your 18, 19, 20, 21% interest rates and say, yeah, you don't need to be paying 21%. Come do business with me. I'll only charge you 17%. That's a real business. That's a real business model, and companies that take that on do very, very well. And there's a lot of trade-offs that go into that equation. Companies that charge 17% typically know a good portion of the loans that they underwrite are not ever coming back. Question? No, just stretching. Okay, with all that as our framework, let's zip through some of these slides and I'll give you a tour of how you might see this on Verizon's balance sheet. Know how the fixed income statement is presented. This will look familiar, hopefully, fingers crossed. We always order the balance sheet from the most recent items to the longer dated items. So current liabilities show up first. Current is defined as coming due in 1 year or less. So we'll see cash payable as a current liability. On this balance sheet, we have accounts payable and accrued liabilities, accrued expenses, accrued vacation. What are accruals? Somebody give me a good definition of an accrual. Like in this case, it might show up on the balance sheet under accrued liabilities.
Is that gonna be like work that employees have done, but they haven't yet paid?
That's a good example. Theoretically, philosophically, high level, if you just want to conceptually, is the word I'm trying to look for. Conceptually, an accrual is something that we need to report on the balance sheet in this case to accurately reflect the positioning of the company. But we haven't had a specific accounting transaction yet. If we've had a specific accounting transaction, meaning money walked out the door, in exchange for that money, we got a good or service, then it's not an accrual. We're accountants. We know how to record transactions. If it's a transaction, it's already recorded. It's already on our books. An accrual is something that we need to record, but we don't have a transaction associated. And the example you just gave is a good example because at the end of the year, most companies have accrued a payable that they owe to all of their employees because of the wage cycle.
Services have been taken.
What?
They have taken the services, but
Exactly. Yeah, 100%. Rarely do employees get paid on December 31st. Usually they get paid on the 1st and the 15th. And on December 31st, that company owes its employees for a couple weeks worth of work. So because that's a liability, we need to record it on the balance sheet, but there hasn't been a transaction there yet. So we just accrue for that. And it's wages payable shows up on the balance sheet and wages expense shows up on the income statement. And that's the basic transaction. Wages expense is the debit, wages payable is the credit, And then later, in January, when the calendar rolls over, we will pay off that liability. Wages payable will be the credit, expunging that entry from the clerks. And cash will be the credit. That's at the point when the cash actually goes out the door. That's the transaction that reverses the accrual that we made during the prior period, and everything's done. So we have accruals for all kinds of things. Accruals for wages payable, have accruals for unearned revenue. We have accruals for portions of insurance that we haven't used. We might have accruals for royalties. We might have accruals for, you name it, something that we owe or something that's owed to us that just hasn't happened yet. So here's slide number 3, gives us that basic definition.
So like prepaid insurance, the first month's transaction would be reported, but then the rest of the months would be accrued. You paid 12 months worth of, or rent. You paid 12 months worth of rent. The first month gets recorded, but then the rest of the 11 months is an accrual of rent.
Prepaid, if you have paid earlier, it will be a prepaid, right? An asset.
She beat me to it. I was trying to think of the account name and she beat me to it. So you'd have prepaid rent, yes, that's exactly right.
And will the period pass, it will be turned into expense and the rest will be remain in the asset.
So now reverse it. What's the entry for the landlord? The landlord accepted the cash and what's their entry?
They have received in advance. So it's a kind of, I guess, liability for them.
Yes,
And the revenue one will be recognized and the rest will, like, if the period has passed, that period will be recognized as their rent income. And the
okay,
rest
you're 100% right. The term that we use to describe that
That's
transaction is, we talked about it last time we got together,
Prepaid rent was
and
in
unearned revenue
unearned rent.
or deferred revenue. Remember, those two things are the same thing, and I spent years getting them. Don't fall into the same mistake I did. Those are the same thing. So, okay, on this slide, our authors give us examples of those liabilities. So we already talked wages, unpaid interest, income taxes owed, other expenses. That's the first category. Those are more typical. In the second category, we have contingent liabilities. So depending upon something else, but the timing might not be known with certainty. 2 examples are litigation. So we got a court case outstanding. We know we're probably going to owe something. We should accrue for that. Okay. One wrinkle to that is that even your lawyers will advise you of this because has very strict standards. And with regard to these contingent liabilities, they are dependent on the occurrence of future uncertain events that meets the standard of, I think it's on the next slide, known and likely. Okay. So if it meets that standard, an attorney can call you up on the stand to depose you as the CFO. And he can ask you he or she can ask you some very pointed questions. They can say, oh, well, Mr. Cushenberry, I see here you reported this contingent liability on December 31st, 2022. Were you aware of the standards? And I puts it in front of you and say, yeah, that's known and likely. Oh, so you admit it's likely that you've done fault and will therefore lose this lawsuit. Okay, you don't want to put yourself in that situation. Which is why some of these contingent liabilities don't necessarily get recorded in the same manner that would indicate how likely they are. That creates opportunity for us and everybody else in this room as analysts to kind of peer through the curtain a little bit and assess for ourselves what the liability of those lawsuits are. And if you pair this degree track, your MBA degree track, or your master's in science and accounting with a degree from the law school, Catty Corner here, you can pursue what are one of many very lucrative careers in the field of bankruptcy finance, legal finance, other esoteric special situation financing that give you as investors the opportunity to work for large investing firms in a deep niche specialty. And I find that world fascinating, and I know some folks that work in bankruptcy, finance, legal, that the intersection of that, and you can find some deeply discounted investing opportunities that are just really interesting. But it's highly technical and deep niche. And if you're interested in that, I would encourage you to pursue that track because it can be very fulfilling. Warranties, liabilities, that's a little bit more straightforward. We don't know how many of the widgets we make that will ultimately go bad, but we have some idea. Very similar to the conversation that we had last time we got together talking about accounts receivable. What is required of us as accountants when we book an accounts receivable? Remember? Yes, expected loss. We record accounts receivable net of expected loss. Okay, that requires us to make some estimates to estimate what our expected loss is. We usually do that off of historical track record. Warranty liabilities is the same thing. If you're a Ford Motor Company or Harley Davidson or another manufacturer, you have a pretty good idea of what your warranty liability is going to be because you have a track record of 50 years. You know, every once in a while you get a recall. So we factor that in. That creates another opportunity for what we talked about last time we all got together, which is cookie jar accounting. If you want to increase your warranty expense, that's easy to do. Now you have a little reserve you can draw from in the future anytime you need to play that little game of find the penny. And then if you need to play that game of find the penny this year, you just lower your warranty expense. And you go to Wall Street and you say, look at us. Remember all those investments I told you we've been making in higher quality trucks, F-150s, they're paying off. We don't need the warranty expense anymore. And then you all as analysts say, yeah, that's a good story, but I'm going to flip to the back of the 10K here and see what the actual cash was you paid for warranties this year. And you're like, doesn't square. That story doesn't square with what you're printing right here because it says that your total warranties came back and your warranty reserve declined significantly. And if that trend continues, I can forecast higher expenses in the future. As a matter of fact, when I adjust to the accounting and the percentage warranty that goes bad, when I adjust it so that it's the same number as GM or Chrysler or Fiat, your major competition around the world, your story evaporates completely. That's your job as analysts, to be able to see through stories that your C-suite executives are telling. Okay. About wages payable, talked about unearned revenue.
So are accruals only liabilities?
No,
Okay, so they're assets as well.
both examples that we just talked about in this exchange fall underneath the definition of accrual. Prepaid asset, unearned revenue in that prepaid rent conversation. One is an accrued revenue, one is an accrued liability. The technical definition of an accrual is an entry that results not from a transaction. Reword that a little bit. That's not, I don't think my grammar was correct there, but hopefully the meaning was imparted. Okay, these were the two terms that I was trying to think of a minute ago when I was giving that legal example. The standard for contingent accruals, probable, reasonably determined. So if it's a lawsuit, you don't want to be deposed in front of an aggressive prosecuting attorney. Don't put anything down because it has to meet the standard of probable. I think I said likely, but probable and reasonably determined. Warranty expense absolutely falls under the probable and reasonably determined standard. Here's the 10K filing. Everything that we talk about in this class, almost everything we talk about in this class, has a table in the back of the 10K filing to give you the detail that you need to do some analytics. Let's take a look at what the historicals were relative to warranty expense and find out if there's anything about this year that deviates from what it has historically. The deviations, the variability, the standard deviation, those are all pink flags. If you have data that looks like it has for the last 2 centuries, there's probably nothing going on there. But when you get those variations between what a company's done historically and what's done this year, that's your pink flag. That's your opportunity to go do a little digging, find out what has changed. Is there something different or significant about the company's competitive positioning and or strategy that explains this? And if it can't be explained away by competitive positioning or strategy, that's one that you might have uncovered some manipulation going on there with the accounting. This 10K filing is Harley's. So Harley-Davidson looks at their warranty expense, and you can see at the beginning of 2018, they reported a warranty liability of $94,250. So based on everything that they have sold in the last year, 3 years, 5 years, they're making the assumption that they're going to have to pay $94,000 to fix the broken stuff they sold. They guaranteed it. A percentage of it is going to break. They think that's going to cost them $94,000, and that's that number comes from their 10K, so that's in millions, so 94 million. So fast forward 1 year, we go from 2017 to 2018. We've obviously sold new motorcycles, but at the same time, we've obviously fixed a whole bunch of motorcycles that came back broken. We record both of those things. Warranty expense associated with new sales and warranty payable, which would be the liability that we already accrued for prior sales. That liability goes away when we satisfy the liability. So when we fix the broken motorcycles, we no longer have to record the liability associated with that warranty expense. That liability was down. That was initially an accrual. We reverse that accrual when the cash goes out the door or when we satisfy the liability. So it's a liability. When we satisfy it, it's got to be removed from the books. So that's just a reversal of our initial transaction. So remember, the accrual is something that we record that we don't have a transaction for. Well, when we do have the transaction for it, meaning we've satisfied the liability in this case, we just reverse the first transaction. All of that shows up in the back of the 10K, and you can see how Harley reported warranties issued during the year, settlements made during the period. Discard that for this conversation. Settlements is not a warranty conversation. That's more of a recall conversation. You got recalls listed there too, and the balance at the end of the period. So if you've been paying any attention the last couple of weeks, you probably know where we're going next. We're going to compute some ratios out of this. And what's the warranty expense relative to sales? What's the total warranty reserve relative to sales? That's what gives us some context around interpreting history through an analytical lens. Because we can't really put, $131 million worth of warranty reserves doesn't tell us anything unless we know how many motorcycles are out there that we've actually guaranteed. We know that through sales or through revenues. Those two things need to move in tandem with one another. This is the exercise we would go through to adjust or test or kick the tires a little bit on a management's estimate of warranty expense. So what we want to do is calculate warranty expense relative to revenues. We see that in 2016, 2017, 2018, the average of those 3 years is 1.8. So in 2019, if warranty expense relative to revenues comes in at 1.5, we're gonna be saying to ourselves, wait a minute, the average of the last 3 years is 1.8. How are you at 1.5 now? Maybe they're selling higher quality products that are not gonna be recalled as much. Could be a genuine answer. Probably not. You don't just increase your quality like that. So we want to test it. As analysts, we want to say to ourselves, I don't know if I buy that 1.5 number. I think it might be 1.8. That's your historical average. I'm going to recalculate your financial statements as if it were 1.8. So we take revenues, we multiply by 1.8. We say that's the warranty expense that I think is real. And we put that into the income statement. We adjust all the numbers. We revise our net income number down in this case by 4 million, 2018 would actually be positive. And then you adjust the balance sheet to reflect the deferred tax asset, which we haven't talked about yet, but module 10, we'll talk about deferred tax assets, warranty liabilities, and retained earnings. Now we have balance sheets that are apples to apples from a historical basis. We can compare 2019 with 2018 with more confidence. Or if we've done this based on a peer group evaluation, we've plugged in numbers that are representative of what GM is reporting, of what Chrysler is reporting. But this is Harley Davidson, who's Harley compete with. Their peer group, and we can adjust them that way.
Question, what do analysts do in situations where you find a company has taken lots of liberties, right? Like, just so there's clearly a pattern of understating or overstating where it's convenient. What are analysts supposed to do about that?
Well, they can go through this exercise, and they do go through this exercise extensively. And if you engage some of these analysts, which you can do, if you go over to the Bloomberg terminal, you'll find that there are research reports by Bank of America, Goldman Sachs, Credit Suisse, and the telephone number of the analyst is on all of those. You can call those people and you can say, you know, I deputize everybody in this room to use my firm's name. So you can say, you are now an analyst with Two West Advisors. It's the name of our local firm. Okay, so now you're an analyst with Two West Advisors. You have some credibility. They'll talk to you. They won't treat you like you're a student at UMKC. If you tell me you're a student at UMKC, they won't. So tell them you're an analyst and ask them if they'd be willing to share your model. And over half the time, they'll just send you an Excel file with the model in it, and they'll have all of these adjustments if they've made it. Some analysts are better than others, and they have, you know, real deep dive into all of the accounting that they find a little bit that they second guess. Now, the analysts that are really, really good in this regard, they work almost exclusively for firms that specialize in short selling. So they have trained themselves to be so skeptically minded and to have an eye for things that are just not quite right. They sift through dozens, hundreds of 10K filings to find those companies with a high instance or frequency of questionable accounting. And then they try to build a short thesis, which means they try to argue that the company's not really worth what it's selling for in the marketplace. And then they short it. So financial transaction where they borrow the shares, they sell the shares, and they hope that the share price declines so that they can buy it back and repay the lender with the shares that they borrowed and lock in the profit. That's another. That's another esoteric little niche that I find very fascinating in the world of investments, because it's not very common, and you do have to have a trained eye that's highly technical to spot these accounting irregularities. If you're interested in these conversations, pursue that niche. Hold on, I'm trying to remember. Okay, I'm trying to remember the name of this book. I'm going to make a book recommendation. The best book I've ever read on this. is called Fooling Some of the People All the Time. And it was written by David Einhorn, who's a hedge fund manager. And I apologize in advance, or rather I'll just disclaim my remarks because the book reads a little bit like a textbook at times. So it's not necessarily a page turner, but boy, it was for me because I'm a big time accounting nerd and I love the world of investing. And David Einhorn thinks with the skeptic's mind. And he lays all this out in a case study on several companies that he took big time short bets into. And they were contested, meaning that the company he was shorting hired an army of legal staff to refute everything that he was saying because they didn't want it to get out. And they made his life really, really hard. But he stuck with the story, knowing that eventually bad economics are going to win out. When you're running a Ponzi scheme, that eventually ends. You can keep it going for a long time, but there's never been a Ponzi scheme that ended well. And Einhorn was willing to take that bet. And the story that he lays out in this book, Fooling Some of the People All the Time, absolutely fascinating. So check it out if you have time, or maybe an audio copy if you like to cheat like me and listen to him in audio. Sorry for ignoring you there.
Ask a question, like general. You said like sometimes they manipulate in these estimates. So we have this proper system of audit because when companies are audited, there is estimates, reliability, and it's very deeply checked. So how even then companies, play in these estimates to get their desired results?
So a couple of things that you have to remember. Yes, auditors come in. And so Price Waterhouse, Ernst & Young, Deloitte & Touche, one of the big auditing firms, most of the time for a Fortune 500 company, they're going to look at all the estimates that a management team has made. And then you have to think skeptically there and again, because it is an estimate. And the auditor knows it's an estimate. So neither the auditor nor the management team has a crystal ball. Nobody knows what the number is going to be. So the auditor comes in and they're having a conversation with the management team. And the management team is trying to get the auditor to buy off on their new estimate. So there's a back and forth. If the auditor says no, what is the management team's recourse?
Mostly they make them come to their terms or try to get their view. It's depends.
So persuasion
Yeah.
is one tool that they have at their disposal. What is the most powerful tool they have at their disposal? Anybody?
Management,
Yes.
mostly if they have strong backing to that, or maybe I need experts backing to that review.
More,
That's more.
Yes,
credible.
everything that you've just mentioned is a part of this process where the auditor and the management team come to terms on what's ultimately published in the 10K, because the auditor is going to issue a report at the front of that 10K that says, we find these results do not materially misstate the conditions of the company. That's another standard that is pretty loose, really, when you're talking about a qualified or an unqualified opinion. That would be an unqualified opinion that I just shared. The biggest tool that management team has at their disposal when they're having conversations or arguing or negotiating or whatever you want to call it with the auditor is you're fired. It's management is the one paying the auditor. And the auditors know this. So they kind of,
Agree to the terms.
okay, so if you're an auditor, and I have a lot of friends in the good profession of auditing, but if you're an auditor and your largest client says, nah, we think our warranty expense should be 1.5, and here's the reasons why. Where are you gonna put it? On some of these auditing engagements, there can be $1 million in revenues up for grabs just in that relationship.
Hmm.
always remember that it's the company management teams that pay the auditors. That's just the economics of it. So you guys all have jobs. Most of you have a current job currently, or if you're a full-time student, you probably had a job in the past. So imagine in the situation you're describing, the power dynamics at play. The auditor is in effect talking to his or her boss. So when you go in and sit down to have a conversation with your boss, what's that feel like? How hard do you argue for whatever it is that you're arguing about? There's a power dynamic at play, which thank goodness for the field of auditing. We probably have the best field in the whole world right here in the United States. We have some of the strongest systems at play. But you don't have to look back very far at the history of our financial system to recognize instances where this has gone very, very bad. And that's why when I graduated from college, it was called the Big Eight. You had 8 auditing firms that did 90% of all the work with Fortune 500 companies. Now, how many? Now you have 4. Some of that was legitimate M&A consolidation. Others like,
Now they are coming to 3.
yeah, like, some of them just, they were so flawed internally based on incentive misalignment. And they got competed out.
Can auditors be held for litigation for if they do agree and they just,
That's what happened to Arthur Anderson. That's what happened.
by outside sources or by their?
I don't remember who the auditor was on Enron.
Oh, boy.
It'll come to me. But yes, absolutely.
Okay.
They can be held liable for the job they're supposed to be doing that they did not do. You know, they come in and they say they did their job and performed this audit and ultimately it.
SEC mainly held them accountable on the malpractices like.
Yeah, so they can be sued by the government, but the civil cases can oftentimes be an order of magnitude greater in terms of payout and consequences.
Now, that's a little bit different than checking their estimates. Good. My friend's an auditor at KPMG.
Yeah, that's,
He
so
talks about, he's like, we're not looking for, is it like them lying? They can't really look for fraud.
we're probably talking about the difference between fraud and incompetence. Now, an auditor is rarely expected to uncover fraud, but if an auditor can reasonably be expected to uncover something based on accounting anomalies, like if this warranty expense all of a sudden in a single year goes from 1.8 to 0 or 5, and the auditor says nothing about it, they can get themselves in a little bit of trouble, especially if some of those inquiries were questions that would naturally have uncovered a subsequent fraud. You could argue that the attorney would argue negligence. The attorney would argue negligence, which is tantamount to fraud in many courts. Gross negligence is the term that I was looking for. And I'm not familiar with the line of demarcation, but I know legally that's a standard that changes the situation significantly. So that legal standard, if you ever cross the line from negligence to gross negligence, which is a different standard, but gross negligence, they'll treat it as fraud. Okay. Yikes, 14 pages into a 50-page deck and we got 15 minutes. Okay, so let's do this. Fortunately, I have been yapping contemporaneously about many of the subjects in the back half of this deck. So no, short-term debt shows up as notes payable, accrued interest. Those are standard items on the balance sheet. The entry for those is pretty self-explanatory. You should have been into contact with that in the past. this is a very simple slide. The note that I wanted to make sure that I conveyed to everybody in class is find this table in the back of your 10K, the current maturities of long-term debt. Current maturities of long-term debt will not only tell you what your company owes this year, but also next year, the year after that, and the year after that. What I want you to come to some determination about is the wherewithal and cash flow generating abilities of your company will satisfy those liabilities. So as an analyst, you need to be able to look at that table and recognize that your company has a plan to pay those debts. If there's any red flag there at all, that is your cue to do some digging. Ask your management teams, how do you plan to pay this? There's a term called evergreen debt. Anybody know what evergreen debt is? Okay. Evergreen debt is debt outstanding that a company intends to pay off by borrowing from another bank or another institution or utilizing another one of those bond transactions that I described at the top of the class. Be very mindful of evergreen debt. It's a common strategy that companies employ, and when the financial markets are behaving quote unquote normally, it's not a problem at all. You just borrow some more debt, pay off the old debt that's coming due, and keep on doing business. And it happens all the time. Until the financial market seize up. And then in a market like 2008, 2009, when you have all the counterparty risk, you have companies like GM, companies like Chrysler, American stalwarts that have to get a bailout from the government just to keep operating. Without those bailouts, those companies would have gone bankrupt. And a lot of companies did go bankrupt during that time. So evergreen debt can be very, very risky. And you'll come to an understanding of how much risk a company assumes by finding that table in the back of the 10K. Okay, this next section was basically my big introduction about how long-term debt trades. It can trade at a discount. We talked about the issuance of bonds with an underwriter like Goldman Sachs. The underwriter is going to receive a fee to subsequently sell small denominations, usually $1,000 of face value bonds to the public. Those are investments which can be sold in the secondary market. And when they are sold in the secondary market, the prices now become a function of what the buyer is willing to pay. And what the buyer is willing to pay is 100% determined by the opportunity. Meaning, well, what other bonds can I buy in the market? Those other bonds yield 6%. So now the price of the bonds has to fluctuate so that they're matching the current market yield or the effective rate on the price of the bond. And here's the math behind that. You'll be asked to do this in your homework assignment, and you might also be asked to do this on the test. So just be familiar with this math. If we're dealing with a bond that has a 6% interest rate, then we're making semi-annual interest payments. In this example, we have a $10 million bond where the face value is 10 million. So we can see, using the present value functions, that 10 years times 2 payments a year is 20 payments. $10 million times 3% per payment equals 300,000. So the total cash flows from the coupon payment are 6 million. And then the cash flow, the single cash flow at the end of the term is 10 million. So the bondholder is going to get the principal back. So you get 20 cash flows of $300,000 a piece and 1 cash flow of $10 million for total cash flows of $16 million. Now, let's calculate the present value of these cash flows coming from that bond. The present value of the $300,000 worth of interest payments can be calculated by using a financial calculator or an Excel spreadsheet Or the present value of an annuity factor, which is 14.877, if you use the present value of an annuity table in your book. Present value of those 20 cash flows is $4.4 million. The present value of the principal repayment at the end of the term can be calculated the same way, using the present value factor of 0.55. That becomes 5.5 million. You add up those two numbers, and they equate to the $10 million face value. Okay, gets a little bit more complicated. Now, let's assume investors, this is the example that we gave at the top of the class. Let's assume investors now demand a 4% interest rate. Interest rates just went up. When our authors say investors demand it, well, that could be an environment like we've experienced this year. The Federal Reserve is raising interest rates. So all the bonds that sell in the secondary market, they're now comparing the price of the old bond with what they can get. If they went out and bought a bond today they can get 4%. So they demand 4%. That's going to affect the price of the bond. So now let's go through this calculation again. We know we have interest payments that equate to $300,000. What the bondholder is going to get semi-annually. Those payments are the same. That's the point I'm trying to make to my clients. The payments that you get are identical. Interest rates just went up, but your payments are the same. Unfortunately, because interest rates are now 4%, the present value factor is 13.59, and the present value of those cash flows is 4 million. Do the same thing for the principal that we received at the end of the term. The present value of that $10 million cash flow becomes 4.5. And now, instead of $10 million, we have a bond that trades at $8.6 million. So if we sell that today, we will get $8.6 million and we will have realized a net capital loss. If we hold that till term, we're going to get the same exact cash flows as we did 6 months ago. So is it really any different?
So the payments will never change, right? Even if it's like sold to somebody else, so they would get also the same payments for the bond. Like I don't know, I think it's semi-annually, so it's gonna continue at the same rate.
Because the payments are identical. Yeah. Now, because the new person, the new buyer, only paid $8.6 million, their return is going to be a little higher because at the end of the life of the bond, they're going to get 10 million. So the difference here between 8.6 and 10 million is $1.4 million worth of profit-ish. That transaction, that profit, which we call a net capital gain that the new investor recognizes, causes this bond to sell at a discount, but it causes the effective interest rate to be 4% instead of the 3%. The reverse of that transaction results in a bond that trades at a premium. We just looked at a bond that trades at a discount. If interest rates decline to 2%, they were at 3%. If they decline to 2%, we now have the reverse, whereby these cash flows are discounted at a lower interest rate, resulting in a higher present value that, in this example, sums to 11.6 million. The value of that bond, if we were to sell it today, has just gone up.
So would you buy the premium bond because of the higher interest payments you're going to receive for it? Because ultimately your principal, the money you get back on, it's going to be less than what you paid for it.
The answer to your question is it depends.
That's fair.
Hold that thought.
Yeah,
I don't know. I I don't want to take it down a rabbit hole that's going to confuse everybody. Okay. But I want to share some more information on that. So put a pin in that just for a second. This is one of the tables that I want everybody to find in your 10K filing. It's going to show every outstanding debt issuance that your company has engaged in for the last potentially 10 or 20 years, everything that they have outstanding. And I want you to take notice of the interest rates that they've had to issue debt at in the past. And this is what I find alarming. Even looking at this. Look at, this is Verizon. In 2018, Verizon had to issue debt that paid 8.75% interest. Seems high to me. Verizon is a huge company. Now, every time you issue debt, it comes with a memorandum, a prospectus, some other issuance documents. And those documents are contractual in nature. Ultimately, issuing debt is an exercise in contract law. And for any of you who have been through business law, you know that contract law is just an agreement between two parties. And that agreement can say whatever you want it to say. So this agreement might say that that debt instrument gets paid off last. It's behind every other liability that the company has on its books. And if that's what it says, that might be a good and sufficient reason for that interest rate to be so high, because the buyer, or the lender in this case, really has no recourse if anything goes wrong at that company. There's no collateral that's been put up. There's no other terms, there are other covenants associated with that debt offering that offer protection for the lender. Okay, maybe. All of these documents should be available to you through the company's investor relations website or the SEC. You go to sec.gov, you should be able to find all of these documents, and you'll be able to look at what the terms of those debt instruments are. That's a little bit beyond the scope of this class, because those publications, those filings are extensive in nature. But just like bankruptcy, just like short selling, that's another area of finance, debt obligations that can get very, very interesting. So take a look. But my point is, be able to explain why those interest rates are so high. If they don't have a good reason for it, then that's just the market telling you that there's something going on at Verizon that is risky. Debt, the interest rate a borrower pays on its debt is like a mirror into a world that shows you how much business risk there is inside of that entity. The United States Treasury pays the lowest interest rates because they borrow at the risk-free rate, meaning there's no risk associated in lending to the United States government. That's why we call that the risk-free rate. There's risk associated with every other loan that you could ever potentially make. And that risk is based on how aggressively the company is financed, what industry they're in, what their competitive positioning is. Take a company like Google or Microsoft or Apple that have no other debt on its balance sheet. A loan to them is probably pretty safe because they are very stable, cash flow positive company. The likelihood that you're not going to get paid back is very low. Take another company with a lot of debt on its books that is going to potentially be a lot more risky and could result in an instance where you don't get paid back, which leads me into this next topic of conversation about a client's credit worthiness, and has created a whole industry to help us as investors, give us as investors resources to identify how risky a company is. Every company that you're working on that has borrowed debt has a rating from Standard & Poor's or Moody or Fitch, one of the largest credit rating agencies in the world that makes a business out of assessing the risk every company represents. And they score these companies with letter grades, A, B, C, D. How creditworthy are they? That's what those ratings mean. They give us as analysts an indication of how creditworthy these companies are. And here's an example of specifically what that has meant for the last 5 years or so. The red line on this chart is the yield paid to the 10-year treasury going back to June of 2014. And that fluctuates a little bit. The Federal Reserve has a lot to do with that. Global supply and demand has a lot to do with that. The strength of our economy has a lot to do with that. Notice that the average yield to AAA rated debt, which is the highest, most credit-worthy companies, that has a tendency to fluctuate, about 1.5%-ish above the US Treasury debt. And we monitor what's called the difference between the green and the red line, and we call that the spread. That difference is what bond analysts refer to as the spread. Sometimes the spread is really wide, sometimes the spread is really narrow. When the spread is really wide, that's an indication that there might be value associated with AAA rated debt. Consider buying it. When the spread is really narrow, you're not getting much of a premium to invest in AAA rated debt. You might prefer just to get the US Treasury because that's safe. Now look at the spread to BAA. BAA is the line of demarcation between investment grade debt and non-investment grade debt. Non-investment grade debt is what we used to call junk, but it's been rebranded to non-investment grade debt. Sounds a lot better. Same economics as what we used to call junk. So be mindful of that. And you just notice that there's just typically a higher spread. And there is a higher spread because it's riskier. It's just naturally risky. Check out the total rating scale on slide 41. I want to make one point on slide 43, and the point that I make is that this exercise, this framework that our authors share, which is unique to Standard & Poor's, is basically the same framework that we're using all semester long to go through and analyze the companies that you've selected from the perspective of an equity analyst. If you're a debt analyst, you do everything that we do that we're touching on all semester. But you're primarily concerned with the cash flows coming off that company paid to debt holders versus the cash flows generated by that company paid to equity holders. What's the difference? 2 lines on the income statement. Earnings before interest, taxes, which is EBIT. Then you have earnings before taxes. Then you have net income. So what we care about is net income. What they care about is earnings before interest. 2 lines up on the income statement. Only difference. Everything else that we touch on this semester is also relevant to a fixed income analyst, which means that we are currently in the process of training ourselves to be analysts for companies like S&P 500. So just know that. And gang, I think that's it this week. Slide number 46 does have some useful information. If your company is on the verge of being downgraded, meaning losing some of its credit worthiness, going from a AAA rated company to a AA rated company, that's not a good thing because their borrowing costs are going to go up. You might get ahead of the game a little bit by recognizing some of these ratios. We're looking at all of these ratios this semester. You need to be familiar with all those ratios because it gives us some health check on how your management teams are running their businesses. Well, if you got an EBITDA expense, EBITDA divided by interest expense, or EBITDA margin is probably a better one. AAA rated companies are at an average EBITDA margin of 30%, AA 24, single A 19. Well, if you got a AAA rated company, but a 19% EBITDA margin, yikes, that might be a little bit of a problem. That might be an indication that your company is about to lose its credit rating. Pink flag, red flag, should cause you to ask some more questions, think a little skeptically. What would happen if they lost that credit rating? How much additional expense would they pay in interest? Those are the types of questions that you need to be asking. Okay. That's it. I wasn't gonna touch on the appendix in this chapter anyway, because it talks about time value of money concepts that those should be table stakes and prereqs for even getting into this class. So I will let you give yourselves a little refresher on those concepts independently of class. That's it, gang. We'll let you all get to some Monday Night Football. Go Chiefs. Thank you.